Tim, it's good to have you. So obviously some worrisome signs within this report. Prices paid rising. You have new orders below 50 as well as employment, both sagging below 50. What are you hearing from the business community just in terms of the macro conditions right now and whether or not it is deteriorating at a rapid clip?
Yeah, thanks, Shauna. So I think the whole story here is really around the tariff issue, which is really the prices index. Because the fact that the prices index went up 7.5 points, it's really impacted the new order levels, the inventory level, as well as the supplier delivery number. And let me explain. So our prices index really measures the width of the lake, not the depth of the lake. What this really says is that a lot of companies have been impacted by steel and aluminum tariffs. Now, I think they're 15%, 10 or 15%, but the spot market immediately went up to that tariff price per ton when the tariffs were announced, even though they don't go into place till the 12th. If you look at the spot market, you look at the Midwest differential for delivering aluminum, it's up 20+% since I last spoke with you last month. So what that has done is it's slowed down the new order rate because suppliers are not going to take new orders unless they agree with their customers about who's going to pay for this. It's also caused an increase in the inventory count because we pulled forward deliveries over the last couple of months to try to avoid these tariffs. It's also, probably some impact from the Lunar New Year stuff showing up. And it's impacted the supplier delivery number. They raised the number because some suppliers are obviously refusing to deliver their product unless there's an agreement on who's going to cover these tariffs. So the good news here is that the new order number, the supplier delivery number, inventory number are probably a blip. It might be this month. Well, we got Mexico and China coming not too far down the path here. That'll probably, if you remove the tariff issue, the one-time tariff issue with steel and aluminum, those numbers will probably recover. The prices number is going to stay elevated. I mean, that's really the story this month, is that consistent with the administration's stated goal of the External Revenue Service and its basis is tariffs, that this number is going to stay high. I would really quiver to think of what would happen if the Mexico and Canada tariffs go into place in the next couple of days and what that would mean for the PMI for March.
What would it mean?
Well, it's probably going to mean that new order number gets even worse. The supplier delivery number gets even worse. The employment number probably drops more because people are still releasing people now when they really shouldn't be releasing people now. They were much more optimistic a couple of months ago about, okay, we de-staffed to the right headcount level consistent with our forecast. But given the uncertainty here driven by the tariffs and the impacts that could have on the Fed's interest rate policies, they're continuing to de-staff people using primarily attrition and freezes as a tool rather than layoffs this month, which I think is it's good news. So they're not acting as drastically that they had been in Q4 of last year, and even to some extent last month. We thought the employment number would stabilize by now, but what business people are saying is, in this space of uncertainty, I don't think I'm going to carry this headcount. I'm not going to reduce my headcount proactively, but I'm going to attrit down, meaning if somebody quits, I don't want to replace them right away, and I'm only going to replace people that are strategic to the company. So, and you would expect that if those Mexico and Canada tariffs go into place, that prices number could easily be 80 plus, if not more.
So what does that tell us more broadly about risks to the economy, risks of a recession, risks of even stagflation moving forward, Tim?
Oh, well, thank you for that question. Well, I mean, if you stay on the path that we're headed on, I think it's going to be a tough route. We've been saying for a while here that the second half, when the tariff as a tool was announced many months ago, we knew it was announced. The administration's continuing to deploy that strategy. If they deploy the strategy, the second half of the year is not going to look good because it's going to, first off, it's going to clog everything up. Our panelists already said back in December that their ability to pass price increases through were half as good as they were last year. So they don't really think that they can pass the prices through. So either make it up in productivity, which is only so much you can do, or you eat it and then it's a margin. So, I mean, that's kind of the summary on this, is that there's no magic about this. When you raise the price of input goods, somebody's got to pay that cost, and eventually it ends up in the product that you're selling.
Yeah,
so,
Tim, you said it would not look good for the second half of the year. Does that mean recession?
I'm not sure. I don't want to call that. That's well beyond my pay grade. But I will tell you that our prices index has been very consistent for the last year and a half about what's happening with the CPI and the PPI. So when we show a weak growth in prices, you're seeing a stable CPI or a PPI. When we show a more dramatic increase in prices, think 55, 56, you're seeing maybe a 10th tick up. Now we're at the 62 level. So what does that mean to the CPI and the PPI that comes out this month? I would say it's going to go up. And then what does that mean to the Federal Reserve? You know the answer to that. The other thing here is that our new order number generally does a pretty good follow with the industrial production numbers released by the Federal Reserve. So we're now down in the 48.6. I would guess that their IP numbers for the prior months are not going to be as positive as they have been. And all that's going to weigh into interest rate decisions that may or may not change the administration's policy. The Federal Reserve can only react to what's happening. They don't proactively do things in the market to change or even to butt up against the administration's policy. So it's really up to the administration to make some decisions here that, it's nice to say we're going to raise all this money through, quote, a tax on imported goods. You saw what it did to the steel and aluminum markets, which is just an industry issue. What happens when you do reciprocal tariffs across everything? I shudder to think.